Views expressed by Camaplan podcast guests may not reflect those of Camaplan. Camaplan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. Camaplan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Hi, I'm Michael Duncan, and welcome back to The Road to Financial Freedom. This podcast is brought to you by Camaplan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Our goal is to help the listeners learn how they can achieve their own financial freedom through the experience and stories of experts that have done just that. Today's guest has served as a strategic partner at Trinity Investors since 2019. He's a 13-year veteran of Wall Street, trading institutional mortgage-backed securities. He spent 8 years as a vice president at Southwest and Hilltop Securities, then another 5 years as managing director at a boutique broker-dealer in New York. He focused on non-agency MBS and derivatives, trading in excess of $10 billion in securities. I am here today with Suraj Jagannathan, and I am very excited to welcome him to the show. Suraj, how are you doing today?
I am doing awesome, Michael. Thanks for having me.
Oh, of course. And for those listening at home, this is actually my first official podcast recording in person. So I've had the pleasure of getting to hang out with Suraj a little bit today. We got him a Philly cheesesteak. It did have pepperoni in it, though. I don't know if you noticed that. I'm not sure how I feel about that overall, but that's a conversation for a completely different podcast. But yeah, Suraj, it's been awesome having you here at the Camaplan office. And I would just love to kind of start this out by getting a little bit of background on you. You know, why are you here? What is it that you do?
Yeah, no, absolutely. So it's good to be here in Philly. The weather's been great here from Dallas, Texas. And I know a lot of people in Philly don't like Dallas, but what we don't like about Dallas is the heat. Okay, so but
Very
Philly,
fair.
Philly and the outskirts are all a great place to be and come visit. My sister lives in the area. Happened to be here for a week visiting some of our existing investors within our Trinity Investors platform, and so it's great to be here. So thanks. And at Trinity Investors, we are a $7 billion in assets under management real estate private equity group. We have about 4,000 active investors who currently invest with us. And we're not a fund. We do everything on a deal-by-deal basis. It's been wonderful. We've built a great base in Dallas, but over the years have been able to expand across the U.S. into numerous major cities, including Philadelphia. And so it's been really wonderful spending time here. A lot of our team members, including our managing partners and myself, come here quite frequently to hold events here. And, Philly, the people have been awesome. They've certainly embraced us as Dallasites.
Yeah, we do our best. Just, stay away from the Cowboys-Eagles conversations and we're normally fine.
We should all stay away from those. Right?
Agreed. But so I do want to get to, Trinity Investments, what you guys are doing there, but I'd really like to start by taking a look back. How did you land at Trinity? What brought you here? What was your path to getting here to this point in your career?
Yeah, that's a very good question. I started my path in 2006, and I was a junior bond trader trading mortgage-backed securities for a small regional firm called Southwest Securities in Dallas, Texas. And this is certainly prior to 2008 when the collapse happened, and I was in the thick of it in evaluating and looking at mortgage-backed securities. When the collapse happened in 2008, there was a period of about 2 years whereby there really wasn't anybody doing anything in the markets.
Yeah.
It was very small buyers. People wanted to sell, but you couldn't sell because there were no buyers. And I think it happened across the board with everything in terms of equities and fixed income and everything. What that did for me at a young age was it allowed me to grow and learn. So I spent 4 years evaluating thousands and thousands and thousands of bonds and loan level data of each one of these mortgage-backed securities. It probably was one of the most rewarding things I could have done because of the amount of work I put into it, but the receipt I received in terms of knowledge of how to analyze anything going forward was amazing. And I take that still to this day to say, here's how we need to look at things. That was really a pivotal part in my career because when the buying started happening in 2010, and it happened across the board with the equity market as well as the fixed income market and every other asset class, it started happening quite rapidly. And being young, I didn't realize it would happen that rapidly. And the phones would be ringing, just like you see in any movie.
Yeah.
When something big is going on, the phones are ringing, people are picking them up. Hello, hello, and they're throwing orders like you're on the floor of the exchange. It was happening like that. I was in the office at 6 a.m. every single day, already ready to work. I wasn't leaving till 6 or 7 p.m. because we would just spend mornings and evenings and analyzing bonds while we were doing it during the day.
Yeah.
I'll take a breath right there, and I'll let you ask any questions because that was a mouthful.
Yeah, I mean that there's so much to take away from that. There's so many different directions we could go with that conversation. But I think the first thing I'd like to know is just your thoughts and feelings. You're 2 years roughly into this career, and the housing market crashes. That's in a sense that's your livelihood. It directly impacts you, and obviously directly impacted millions of Americans, but it directly impacted you in a way that is not very typical for most people and the way it impacted them. So, what were your thoughts as it started to happen? I'm assuming there was at least a little bit of, I'm scared, I'm worried. Obviously, you took it in stride, taking that time to really just sit back and learn. But, what was the very beginning of that like?
I was 27 years old at the time. I was very young. I didn't have what a lot of the average American did have, which was a job, a house, a family.
Yeah.
When reading articles and seeing the distress amongst people within your community as well, you realize the magnitude of what's happening. But sitting in my seat, I didn't realize what was happening. I was very focused on a daily basis and doing my job and my responsibilities were to evaluate these bonds and the loan level data of the bonds. When you would get out on the evenings or the weekends, you would see the impact and how it was happening. And again, you start to look deeper and to ask, how did this happen? And I'm not going to sit here and lie to you and say we didn't catch a lot of flack when I would tell people what my job was, and they said that I was part of the crushing part of the industry, and I won't deny that either, because I think that Wall Street had some impact in how they would operate on a daily basis. But our job and responsibility was to give investors returns in the fixed income space, and in particular the mortgage-backed security asset class. And the impact of what we realized we could do for investors and finding them value in diamonds in the rough bonds that would give them, whether it be short-term or long-term value, and happen to actually value rather quickly. Because it was my responsibility to take down and inventory bonds that were going to create value for the investor once they purchased them, specifically long-term. But it was actually happening more on a short-term basis because the values were going up quite rapidly.
Yeah.
And, the fixed income space isn't for everybody. Just like the equity space isn't for everybody, and the private asset space isn't for everybody. I think there's a portfolio that an investor needs to build, and when building that portfolio, you also get educated on all of the different asset classes and opportunities that you can invest in. So at a young age, there was a couple things I learned really quickly, which was that there's opportunity everywhere, number one, and number two is those opportunities sometimes impact everybody and other people that you don't know in a negative way.
Absolutely. So, first of all, when you say that you're 27, that's how old I am right now. I'm aging myself a little bit, but it's just interesting to hear that perspective specifically when I'm looking at it. In 2008, I was, needless to say, I was not aware of the house market crash to any degree. But it's interesting to think about how that would impact my life right now. And, that's just a very interesting perspective I hadn't really thought about. But so after that, you spent years going through these bonds, really starting in the fixed income space. And, now you're in a very different space. How did you get there? What was the middle ground there? What was the gap?
Yeah, in a lot of cycles that happen, there's opportunity that happens, and then as spreads start to compress and come in, whereby the value isn't there anymore, whether it be for the investor or, for an example is if you're buying at the bottom and everything runs all the way up to the top, and now guess what? The return that you expect or that you received a year ago because you were purchasing is not the same as what you're purchasing today.
Yeah.
Correct? We started to see spreads thin out quite rapidly. But obviously mortgage originations weren't happening either because there were less people getting loans from a jumbo perspective, and even, the government agencies, Fannie, Freddie, and Ginnie. Housing didn't come back. Developments had stopped because we had an abundance of inventory out on the market right now owned by some institutional, some local banks, and even just lenders in place right there. Because with Dodd-Frank coming in now, and they're revamping all the standards of how to trade on Wall Street, but then banks came in and put regulations on how lenders need to reevaluate loans and how they're given to, because that was part of the problem. It was, you can't just give a loan to anybody.
Yeah.
They had ninja loans out there, no income, no job, no assets.
Yeah.
Just giving them to everybody. If you saw the movie Wall Street or it was one with Steve Carell, I forgot which one that one was, but those depicted the way lenders would give loans to individuals, and it was predatory. It was based upon commissions and fees. That has now been reined in significantly. Banks are effectively stronger than ever now because of the new rules put in place. So getting a home loan is much more stringent on the banking perspective. But because spreads were compressing so rapidly during that time period, I myself found that analyzing these bonds and having less bonds to trade was not becoming as interesting to me anymore. So I have a lot of friends who are in the finance field, all in different aspects of it. I've got guys who are still in fixed income. I've got friends who are in hotels, in multifamily, and they all individually own these assets on their own. So when chatting with them, I had one of my very good friends asked me to come join him and to buy some hospitality assets. So we were going to buy hotels, and this was in 2015. So we proceeded down the route of purchasing hotels, and it got me away from the analytics of the bond side of it.
Yeah.
And so now I'm actually analyzing the actual asset itself. Instead of analyzing loan level data, I'm now analyzing the asset itself, the market itself, and is this the market that we want to be purchasing in? And can we get investors to participate with us to help us grow this, like in any other asset that you might buy? And so that's how I got into that industry, because the hotel industry has always been actually a pretty solid and well-rounded industry. So I jumped from fixed income immediately to hospitality assets.
Yeah, I mean, I can't imagine much of a bigger jump where, obviously still related. There's a lot in common, but I mean, like you said, it's a very different industry.
It was a 180. It was a 180 move that I made, but it opened my eyes to other things out there, and that's exactly what I wanted.
Were there times that you ever doubted your choice, or kind of regretted or made a mistake or something and began to worry that you had made the wrong choice? When
I was trading bonds and the market was just going straight up, I knew that wasn't reality.
Yeah.
Okay?
Yeah.
But sometimes you just have to enjoy the ride.
Absolutely.
Okay? And I wouldn't say that I ever doubted my choice. I did realize it was harder than what I expected it would be. In life, and what I've endured is that as life starts to go up, it's not always going straight up when you go up. It's going to go up and down, up and down, up and down. You could be on a trajectory all the way up, very similar to home prices, right? Home prices can go up and down and up and down, up and down. Now, they could go higher than they could go lower, but ultimately, you're going to go with the ebbs and flows of anything. And so that was in my mind, and knowing I had to deal with the ebbs and flows with whatever came out. And nothing is going to be easy. And this was around the same time when podcasts started coming out.
Yeah.
And so I started listening to a lot more podcasts, and you start to understand, instead of just your circle around you, but people across the world are or have dealt with adverse situations, but
Yeah.
that's what made them better to go straight up, right?
Yeah,
And
I
so-
mean that's something I love talking about on this podcast, which is, I'm a big proponent of the people that are listening hear me say this sentence basically every week, but I'm a big proponent of the idea that you learn more by making a mistake than you ever do from succeeding. Because if you just succeed all the way there, like what did you really do to earn? Not to say it's easy, but you learn so much from messing up, from making a mistake.
Let me say this: is the ones who just continue to have success straight up, ultimately, your ego tends to make you think that you're smart and you're smarter than the game. And the reality is you're not.
No.
You just haven't been humbled yet.
Yeah.
I was humbled personally, okay, from an investment that I made that I thought that I was smarter than the game, and I wasn't. So I think having you shouldn't have anything adverse that necessarily needs to happen to you, but understanding that you're not smarter than the game, and you always need opportunity to learn to make yourself better is something that's gonna it's gonna help you with all your successes as well.
And listening and learning from other people that have failed, that have made mistakes, that have messed up, like that can be just as valuable. Because again, these are people that have been humbled. These are people that have learned from these mistakes. And again, if you're not listening to them, there's a good chance that it's exactly as you said, you're smarter than the game.
Some of the most successful people out there have continued to stay humble, and you could see that they continue to be successful because of their humbleness.
I agree 100%.
It's awesome to see.
So moving forward now, we're at Trinity Investors. How did you get involved with them?
Yeah, I love networking. I love meeting new people. Had the opportunity to meet the managing partner of Trinity. His name is Sanjay Chandra. We met, and he liked a couple of the hotel assets we were looking at. He decided he wanted to participate in them. At the same time, we wanted to get to know each other a little bit better, so we spent more time with each other, understanding each other's businesses, past careers, and everything. And we formed a friendship, a very good friendship. And about a year and a half in, Sanjay had said, I think I want you on my team. We're growing something pretty impressive here at Trinity Investors, and I'd like someone like you on my team. Unfortunately, at the exact same time, I was trying to open up another business on the side, which I did. It was a family entertainment center concept, and I was a franchisee of it. So I had to tell him no at that very moment. I needed to go open that business and stabilize it. And then after that, I could, which is subsequently what happened. So in 2019 is when I joined Trinity Investors. It was a great time because their growth had been starting to really hit that ramp up.
Yeah.
And with the elite sponsors that they were bringing in and working with as well. So that's the start of my career with Trinity, and then the explosion of Trinity Investors and their career and success since 2019 has been astronomical where we've gotten to.
So I would assume that, having just started this new company, becoming a franchisee in the family entertainment field asset class, it had to be a pretty strong, not offer, but you had to believe in what they were doing at Trinity Investors to kind of convince yourself that, hey, I'm going to go join their team. You had something going that you believed in, obviously, that you were knowledgeable about, that you were putting your time and effort into. So what was it about them and the way they do business that made you believe enough to join up with them?
Yeah, I'm glad you brought it up in that fashion, because my plan was to scale this family entertainment center concept and open up 10 franchise locations across the U.S. And very quickly I found out that sometimes the timing just isn't right for certain situations.
Absolutely.
And in this case, I believe that the timing was not right. And I subsequently met a person who's started a group and who has a very, very amazing group that's on their trajectory of something that I really wanted to be a part of and thought that was very important for most investors to be a part of, which is the real estate side of it. And so Sanjay in himself has been a very successful entrepreneur, and he's someone that you can always learn from. And so that aspect, as well as what Trinity was growing themselves, both of them really convinced me that, yes, the conviction to be a part of a group like this and to grow and to be a part of it, an integral part of it, was something that I wanted to do. And I'll tell you this. I remember in 2020, this is a segue into something. So I ended up joining Trinity in 2019. COVID happens in 2020. And we have a meeting, and again, this is in the middle of COVID, and we're all 6 feet apart in a big conference room, and we all had to stand up and tell each other how we met somebody at Trinity, when we joined Trinity, and why do we enjoy being here.
It's like a fun college icebreaker.
Yeah, it was a college icebreaker. That's what it was. And so my statement was, I was within an industry in Wall Street that was very dirty. I personally didn't go through anything dirty myself, but I saw it out there, right? Yeah. And then I got into entrepreneurship, and I saw some of the, or should I say franchising, and saw some of the difficulties in there. And I realized then with a group like Trinity, this probably was one of the first groups I'd been with that had the utmost of ethics that I wanted to be a part of. Yeah. I needed that to be a part of. I'd been through so many things in organizations that were unethical. I just couldn't handle that anymore. My mind couldn't handle it anymore. So it was one of the reasons I said that. I go, this is one of the greatest groups I've ever been a part of, and I do appreciate you guys having me. So that was in Fort Worth, Texas. We were in I think it was the Aloft Hotel conference room, and I remember saying that. I loved it. So, and it hasn't changed at all since.
I mean, that just goes right along with, some of the stuff that, we were talking a bit before this podcast. I was learning about what you guys did and, the way that you guys did things. And that, to me, is what really stuck out. I mean, you were telling me, and you can obviously tell the audience, that you're in so many of these deals. You have, the deals that Trinity Investors, open for investors and clients and whatnot, you are in them. You have your own money in them. You have something at stake as well.
Yeah. The two managing partners that started this firm, they started it with we're going to go one investor at a time mindset. Yeah. So we've never taken family office money or institutional capital in the traditional way. They have to adhere to the same rules that a 75K investor comes in at as well. It's a premise that the company was built on. It's what we've continued to adhere to today with 4,000 active investors. If we personally don't invest in a deal collectively as a team, and we don't have approximately $2 million or more into a deal, that deal never sees our 4,000 investors who see our deals right now. Wow. So we want to make sure we have skin in every single deal. And it also allows us to make sure that if we deviate from the business plan, or if something deviates this project from its business plan, for instance, COVID, that we have our utmost focus on getting that plan back to where it was supposed to be. Yeah. Because we've got our money in the game as well.
Yeah, exactly.
And we're at the same level as the limited partner. We don't get any more or any less than what a regular LP might put $100K into.
Do you have an example of a deal that maybe it went sideways is the wrong terminology, but the plan changed. It was not what you initially expected it to be. It's not what the investors expected it to be. But how you approached that change, how you approached the initial failure of following the plan, and what the outcome was.
Yeah, I'm going to give you two examples.
Sure.
One was in 2015. Our plan was to develop an Austin memory care facility with a sponsor. Unfortunately, the developer went bankrupt in year 2. Trinity had to step in and take over the project. We took over the project. We got it back on track and developed. We went through multiple operators and finally found an operator that we felt could operate it the way that we wanted them to. Yeah. In 89 months, I believe it was the case last year, we exited that deal. Ultimately, the net IRR to our investors was a 10% annual IRR, a 2.04x multiple on invested cash, meaning if you invested $100,000 initially, you now have $204,000 over an 89-month period. That deal went longer than what we expected it to, but we worked through the deviation of the business plan to make sure we could get it back in place. Most importantly, get our investors' principal back. But even more in this case was to give them a higher return, right, on a multiple on invested cash. A more recent one that I think a lot of the listeners might resonate with was a hotel asset that COVID deviated every hotel asset in the U.S.
Yes, they did.
The hospitality was the only industry in the U.S. that did not receive government support. Okay, multifamily operators, they got some type of debt. They could hold off on paying their debt payments because there was eviction moratoriums in place and everything else like that. Hospitality got nothing from the government. They got nothing from lenders. They got nothing from CMBS servicers. Okay, one of our assets in Fort Lauderdale, Florida, it was a Sheraton. The sponsor did a really great job of making sure that they were focused on the asset. Our existing investors put up the additional money that was needed right now to continue getting that asset back on plan. To date, we've done very well, whereby the new capital that has come in from the capital call was actually a capital request. The capital request has been paid back, along with all accrued interest to the existing investors. And we're hoping that within the next year that we have an exit or an outcome with that.
Yeah.
And it's going to be a positive one with investors getting more than just a 1x on their money. So we're excited about that asset. And again, it shows that if you have conviction in an asset and you have conviction with a team, a sponsor, and within yourself, and the plan, you believe in the market and you believe in the asset and the sponsor, and you can get the asset back on its plan, you're going to have success.
And I mean, I think such a huge part of that is, as we discussed, like, you guys have skin in the game. You aren't just doing this for the investors. Of course you are, but you're also doing it because it's your own money at stake. That should give, I would assume it gives the investors at least some peace of mind, because they know that you're not just going to leave them high and dry, because you'd be leaving yourself high and dry a lot of the time.
I get 2 to 3 warm leads from my existing investors a week, because they understand what we go through, what we have in terms of skin in the game, money into each deal, and how we do the due diligence on deals. And it's gratifying knowing that our investors do believe in us as much as they do.
Yeah.
And again, we work for our investors. We want to create the best opportunities for our investors. And at the same time, because we have our skin in the game, we're doing it for ourselves.
Exactly.
Right? So it's a great feeling.
I bet. And I mean, that's just, that kind of communication is so important in this industry, and particularly with what you guys are doing. If you're not communicating, to be frank, how is anyone supposed to trust you?
Yeah, communication is huge. When COVID happened, we actually shifted to a more, trying to be more communicative to our investors. Mm-hmm. Through that, we decided to do monthly webinars or videos that we would send out to our investors. Now that COVID is over, we have continued down the route because we've received such praise from our investors of how they like them. It keeps them informed on the markets, the industry, and how it's affecting their investments right now. So we want to continue doing that. We want to continue doing our face-to-face social happy hours in different cities that we go to. Tomorrow I have a mini one in Philadelphia, which is going to be exciting. But transparency, communication, it's the key to an investor's heart, and it's a key to the success of our platform as well.
I couldn't agree more. Transparency and communication, those 2 words, I think, probably the most important 2 words.
You can't grow a platform without transparency and communication. You can't earn the trust of your investors, and frankly, you can't earn the trust of your own team if you don't have transparency and communication. That's it.
And you said it very well. I can't possibly say it better. So we're nearing the end, but before I ask you to plug yourself, plug Trinity, let the listeners know where they can find you, I have one final question for you. Obviously, the name of the podcast is The Road to Financial Freedom. So the one question I have for you is, what does financial freedom mean to you?
Financial freedom is investors understanding what their goals are. And when they understand what their goals are and how they want to build their portfolio to create those goals, and I'll say this, all investors need financial support, advice from different people that are out there, because a lot of people work in different fields, and there's so much information that's out there.
Absolutely.
Creating a portfolio that you believe is going to give you financial independence within your platform of what you want yourself to live over the next 10 to 15, 20 years, or what you want your kids to live like. Mine's going to be different than yours is.
Yeah.
Yours is going to be different than one of my investors is. Everybody has something different. It is creating a plan.
Yeah.
That's what financial independence, financial freedom is. It's creating a plan.
Well said. And Suraj, please tell the listeners where they can find you, how they can contact you if they're interested in learning more about you and what you guys do.
Sure. Again, we are Trinity Investors. We're based out of South Lake, Texas, in Dallas. My name is Suraj Jagannathan. I think if you listen to the podcast, excited to continue and listen to all of the episodes here. But you can find me at Suraj, Suraj, at trinityinvestors.com.
And all of that information will be in the description of this podcast as well. Suraj, thank you so much for coming on. It was an absolute pleasure getting to know you, getting to hang out with you today, and of course having you on an episode of this podcast. So thank you. And thank you, listeners, and I will see you next week. If you like what you're hearing on the road to financial freedom and want to learn more about self-directed IRAs and 401ks, click the link in the description to download a free toolkit with everything you need to get started.